Welcome to the Broken Pie Chart Podcast, episode 87. I'm your host, Derek Moore. Today we ask the question, and maybe answer it, is October the most volatile month for the stock market? Is it the worst month out of every month for the stock market? One, I think you might imagine is true, but you might be surprised about the other one. And so anytime we get into October, thoughts of 87, the 1987 stock market crash, that happened during October. Also in October was a crash in 1929. And so anytime you get to October, you start to hearken back, or people start to talk about those crashes. Is there something about October that makes it, just a worse month than others? And sort of in the grand scheme of things, what does it mean for stock market investors? Of course, I remind people, I'm a big advocate of deploying capital into a portfolio, but also having real hedges, not just diversification that you hope will work when you need it most, but actual hedges. And we've done other episodes. I'll try and link to some of those on hedging a portfolio, getting invested. And when we have hedges, it takes away some of the guesswork. In other words, it takes away some of the need to be right on your entry or your exit. So I'll link to this article I'm going to reference, came out in Market Watch. And the title of the article, and it actually has a picture of Owen Wilson, the actor. I'm trying to think what movie this is. But it's asking the question, is how do stocks typically perform in October? And the title of the article goes on to say why you might want to buckle up. And so, is October the most volatile month? Is it the worst month for stocks? As far as volatile, I'll cut right to the chase. Apparently, yes. And so, in this article, and this is by let me see who this is. This is by this is Mark Hulbert, contributed to Market Watch. But when you look at this article, and one of the things they do is they say, look, October stands out. So they're showing a chart of the standard deviation of the Dow Jones Industrial Average, the Dow Jones, back to 1896, and they're measuring the daily changes. And so, of course, standard deviation looks to have an average, and it looks to see how much it moves above or below that average. Pretty simple, right? So on average of all the months, it looks like the standard deviation around the average is about 1.09%, and that's daily price changes. And so a lot of days in the market since 1896, pretty big sample size. But then they show October. And if you follow the link, I'll put the link to the article in the show notes. So you follow the article. October's average is actually about 1.43% on a daily standard deviation of daily changes. And you may not think that's that significant, but actually it is. To go from 1.09 to 1.43 standard deviation, this is the highest of all the months. And, just kind of looking at this chart, it looks like March, September, October, November, December are all above average. I won't read off the rest of the months. You can figure that out. But those are below average. Actually, January and July are the least volatile from just a standard deviation viewpoint. And so when I immediately started, somebody had sent me this article. And before I read it, I said, well, I wonder if you took out the crashes in 29 and 87, which, look, if you know the average daily change and you know the standard deviation is about 1.04%, something like in 1987 where the market was down, somewhere around 17, 18, 20% in a day, it's not even fathomable that, that could even occur. But the article did address that. And they said, look, even if you take out 29 and 87, both of those happen in October, it's still the most volatile month. So if they struck those 2 years and just look at the remaining days, so you took out 2 days out of 1896 to 2020, it's still the most volatile month. So big sample size for sure. So are there any reasons for this? I mean, the article doesn't seem to come up with any. One of the things that people naturally point to in the article also addresses this, and I'd urge you to go and read the article, is, October is right before November. And what do we have in November? Well, we've got elections. But actually what they did was, and I'll let you read the article, but apparently they looked at, taking out the years, the October returns in years right before elections, and it was still more volatile than other months. So to answer that question, yeah, it is more volatile, according to some historicals. A little bit later, I want to get to some of the, what does this mean for returns? One of the things I think that's important, though, is how prepared is the market for increased volatility. And, I think that's, anyway, I'll save that for a little bit later. So the other question is October the worst month for investors? And months are, over the years, you kind of have, if we look at sell in May and go away, and I think academics have done research on why that may or may not be true. You have the January effect, the Christmas effect, the Super Bowl effect, although I haven't seen any data on that. Of course, that was, for a while, if an NFC team, meaning, the NFC conference versus an AFC team. So, of course, the NFC is, where the Cowboys and Giants, and who else? Rams. Oh, God, I'm not going to name off all the teams. But versus, let's say, the Broncos or the Chargers or the Patriots. Now, the Patriots won quite a number of Super Bowls, so maybe they messed up the averages. But that was a thing for a while where the market did better, NFC versus AFC. Recently, we did an episode where we sort of dispelled the myth that stock market returns, it's really better for one party to be in power versus the other, or one president or the other. I'll link to that as well. I think you find that interesting. We're going to do a pre-election show probably the week before the election. We'll talk about some of the things we see and also the some of the data as well. But, you look at how does this do each month? And it's interesting, too, because that article I recently referenced, they did make the point that volatility isn't necessarily bad. And I would say, volatility, if you've got hedging, if you've got protection in portfolio, you're probably not going to care one month to the next, what happens. You're invested for the long term. But October is not the worst month. October is not the worst month for investors. And I didn't have this data. I didn't run this myself. Did a couple searches online, and you can Google that. But it was kind of interesting. And September is actually the worst month. And so I'll cut to the chase on this. When you look at, the average monthly returns, and I think this study was 1928 to 2020, September, and I don't know if this includes dividends or not. I don't think it's really clear here. But anyway, September, the average is minus 1%. And there are only two other months that have an average percent change each month going back over that time period. And that's February, negative 0.1%, and May, minus 0.1%. And so those are, 3 out of 12 months. But then you look at October, October is not the best, but the average annual return in October is about, 0.4%, so 0.4%. So not negative. You're probably curious which is the best. Well, it looks like July, December, April, and January. So for whatever that is worth. But the other interesting thing too is one study I think I saw looked at when the market's up or down in October, what is the average that's up or down? And I think October, when it's down, it's roughly down 4.5% on average. So it's all the down Octobers over many years. At this point, it's about 90 plus years, and when it's up, it's up around 4%. And the one thing I would say is that when it is down, it's tied for the worst average down with May. So in other words, all the years that were negative in the month of October, if you add up all those. So I don't think, you can really look at this and say that October is, in general, September apparently is the worst month. I would agree, though, according to the data, that October is the most volatile. And the other interesting thing that I took a look at is just the instances of when October was down. So over 90 years or so, and it's not out of line either. I mean, it's pretty much markets are in general up more than they are down. We know that from year to year. In fact, we've done a previous podcast where we looked at some data, and markets are within 3% of an all-time high quite often. So October seems to be the most volatile. It does not seem to be the worst month. And, I think that's sort of interesting. Now, when we think about volatility as option, premium sellers or involved in the options market, volatility is one of the key inputs. And so, when you look and you sort of say, okay, volatility, expected volatility and historical volatility are two different things. And I'll explain really quickly. So historical volatility is you look at something like a standard deviation, you look at actual price changes. So how volatile has a market or a stock or some asset been? And you're looking at what's actually happened. But then there's also the implied volatility. Implied volatility says, what does the market vis-a-vis the options market and options premiums, what is the option market actually saying they are expecting? Back in March, when we saw some of those, March of 2020, of course, we saw some of those really volatile periods. And it was a time, normally the options market prices in higher moves than actually happen, meaning that they price in a worst case scenario than actually happens. Back in March, you actually had instances when the market was underpricing volatility. So in other words, let's say they were pricing in, something like a 5% move, and we were getting 8% moves. And they could be up or down as well. So, one of the proxies for volatility, so, you could look at certainly a chart and you would see the VIX. You could look at the VIX index, which is based upon the S&P 500, kind of that rolling 30-day window of option premiums. You can also look at the implied volatility on the options on a market. You can also look at implied volatility on individual stocks as well. Each sort of market, if they have options, they're going to have a volatility. So, going back to 87, if I can use that as a proxy, and the current VIX construct wasn't exactly the same. But if we look at it's tough to decipher exactly. But if we look back in, right before, in the fall of 87, the VIX was oscillating somewhere between, I think, 16, 17, maybe at the high 25. But let's just say if it was 20 going into October, that was, and again, there's better ways to do this. You would look at the implied volatility on the actual, let's say, monthly options on the S&P, but that implies about a 1.25, standard deviation expected move, and over, let's say, 30 days, that would be roughly, over 30 days, roughly, I don't know, about 6.5, or something like that. The average, the expected one standard deviation move. Now, as I said, there's better ways of doing it. But if I look at the VIX today, the VIX is, close to 27. That implies a move over the month, plus or minus, of about, just under 9%. And so I bring that up because is volatility expected, or was it completely mispriced, meaning completely unexpected? And then you got some moves in October. And that would take additional study and research. But I think it's worth saying because when you look at the options market, and we just did an episode on kind of talking about the Robinhood option traders. That was episode 86, just one week ago. But if you look at that, one of the challenges for new option traders is a lot of times they might buy options that have really high premiums because volatility is really high. And if the market or the asset they're making a directional play on, if that volatility gets sucked out of the market, they could be right on direction but wrong on the volatility being shrunk and the premiums being shrunken down. So I think that's an interesting point. And so when you look at this data, I would say a couple things. Number one is, it seems pretty clear that October is more volatile. Does that mean you have to necessarily do something? My opinion, again, if you have a good hedging strategy, and you probably not going to worry too much. The other point that the article made was when you have a lot of volatility, maybe someone is looking to get into a stock or a market, and again, I'm not an advocate of market timing, but they feel like they want to get in lower. This might give you an opportunity to get in lower. Apple, I think at one point, the standard deviation on Apple this year was something like 75 or 100%. It's like up 100% off the lows at one point. And I would just ask, did Apple's cash flows actually deviate by 100%? Did their earnings deviate by 100%? Of course not. But volatility sometimes creates opportunities. It's clear it's more volatile. It doesn't necessarily mean it's going to be bad volatile. And I think even if you look at a chart that includes 1987, you'd have to be hard pressed to look at a long-term chart and see that blip now as bad of a day that was. The other thing I would say is that October historically is, on average, based upon the data I look at, it's not the worst month, and the months don't deviate that much. So is this kind of more of the tail wagging the dog or the dog wagging the tail? I don't even know how that goes. But we'll see. We'll see. And I think it's pretty clear, too, that it's interesting because that was the question about the election, and they seem to have answered that as well. So, and the other thing, too, is for option sellers, sellers of premium, a higher volatility regime can provide some opportunities because without getting into the constructs and some of the more technical things, if premiums are higher, sometimes that presents an opportunity to do things that are further away from the market, higher probabilities of success and things like that. So anyway, we'll see what happens. As I said, we're going to be talking about the election probably one more time. If you missed that, that was episode 85. I'd urge you to take a look at that. And in that episode, that was just 2 weeks ago. We looked at some really interesting data, and some of it was surprising. You would think the average returns on some of the presidents would have been much worse, and they weren't. And we also looked at, hey, what if you have all Democrats, all Republicans? What are the average annual returns? And again, somewhat surprising that it matters less than people think on a historical perspective. So anyway, we'll wrap up there. Remember, please share these episodes if you have people that you think would be interested in these and might gain some benefit. By all means, share them. Many people are not aware of podcasts. I know that seems kind of crazy in this day and age, but show them on their phone. There's podcast apps, the Apple Podcast. You can get this on what's the other one? Oh, Spotify. Yeah, this is available on Spotify. If you use that, if you use the Google Podcast app, a lot of people don't realize there's a podcast app on Google. So plenty of opportunities. But yeah, rather than waste your time rating and reviewing and 5-starring, of course you can do all that as well. Please share these episodes and remember to download previous episodes. We've got This is episode 87. We've got 86 others, and a lot of those are what we call evergreen, meaning it's not necessarily, if you missed it 2 years ago, it's something that's very, it's a subject that you can still go back on and enjoy. So, all right, everyone, we'll talk to you next week.